Good day, guys. Hope you are doing great. Um, Today we are going to discuss bond and its valuation. I think this is a very popular instrument, and I think everyone in the world have traded or have been trading bonds from time to time. Uh, and I think it has become even more famous during the pandemic, right? Because people are looking for like more steady incomes, and the stock market is of course doing quite volatile and quite fluctuative because of the uncertainty pertaining to the health crisis that of course leads to potential economic problems as well right now and in the near future. Okay, so what is bond? See the name, the bond. um, is basically debt, right? So if you issue a bond or a series of bond, it means that you admit that you owe money to whoever is holding the bond or debt certificate. I could imagine. So if you write a bond, you issue a bond, it means that whoever uh, owns your bond is your creditor, right? Or you admit that you owe money to whoever owns the bond, right? Or hold the bond certificate. Okay, so let's go into our discussion materials. Okay, so you see here key features of a bond. Again, the bond is basically debt, right? So you borrow money by issuing a bond. So you owe money to your bondholders, right? To people who own your bonds or who hold the bond certificates. So par value is the nominal value. So to make it easy to imagine, par value is the amount of money per bond that you will redeem, right, or that you will receive at the redemption day, right, or at the maturity on the maturity day. So, for example, here in the United States, the typical par value is 1,000. So, if we say nothing about a certain characteristic of a bond, it means that the par value is 1,000. So this is a typical or the common value. So if we say nothing, it means what we are talking about a par value of 1,000. Right? In other countries, this would be different. For example, in Indonesia, the typical value is 1 million at 1 million rupiah. Uh, some of them some of them have par values of 500,000 and some other amounts. But if we say nothing, it means that we're talking about the typical value, like 1,000 in the US, 1 million in Indonesia. And then the next one is coupon interest rate. See the name here is coupon, right? Coupon interest rate. So this is the common sense. If you borrow money from someone by issuing a bond, so you owe money to your bondholders. So your bondholders are your creditors. So in order that they're willing to buy your bond, then you have to offer a certain interest payment. And specific for bond, we call it a coupon, right? Coupon payment. So here we have coupon interest rate. How much interest rate we are paying to the bondholders, right? So we call it coupon interest rate. So the other name is stated interest rate or stated, right? Or yeah, you can see we call it coupon. And then maturity, well, this is easy to imagine. Like maturity uh, is the like expiry date, right, or the day of expiration. So on that day, you could redeem your bond and get the par value. Remember here, par value. This is the amount that you will get on the expiration day or on the maturity day. Issue date is the day the bond is issued, right? And default risk means the risk that the whole or partial payments cannot be made by the debtor or by the company. So it could be one or could be both, right? The coupon payment and the par value payment or the face value payment, or you can call it the principal, right? So it's either the company fails to pay coupon payment because of a certain liquidity problem in certain year or certain month, but it could be the failure to pay the coupon and also the principal or the face value. The default risk, again, this is the risk that the issuing firm or the issuer fails to repay its debts, right? Either or both the coupon payment and the face value or the principal payments. Okay, so some typical provisions or typical clauses that appear in a bond covenant is call provision. Right? This is one of them, right? Call provision. So you see the name here, call provision. So this is a provision or a clause that enables the issuing firm to call the bond before maturity. So to redeem the bond before maturity. I could imagine, right? So under certain situation, the issuing firm or the issuer wants to redeem or recall the bond before maturity. And what condition is that? So let's see here. We'll start talking about interest rate here. So if you imagine that you are a certain company that will issue a certain series of bond, right? And of course, the first thing you have to decide is the coupon, right? Coupon. And you see the process later. This is quite similar to like public offering for stock, not entirely the same, but similar. You hire an investment bank, right? So in the investment bank will uh, make the prospectus, red herrings prospectus first, and then the investment bank will do the consulting work as well. So they will conduct research, they will do the road shows, right? And then the book building to this to actually to define or decide the coupon interest rate. Right. So let's say you decide to give a coupon interest rate of 11%. Right. So this is a question, right? Why you decided to give a coupon interest rate of 11%? What is the logic behind like the determination of the amount at 11%? And of course, logically, the amount of interest rate should exceed the risk-free rate. This is, I think, the uh, basic logic, right? The foundation of our decision making. So risk-free rate, for example, in the United States right now, risk-free rate is about like minus 25, minus 0.25 or zero, like close to zero. Uh, in other places, for example, in Indonesia, this would be like 4.5% or something like that. So risk-free rate, again, we define risk-free rate as the interest rate offered or provided by like a government security. Like for example, the T-bill, T-bill interest rate in the United States. Uh, the long-term one will be like a T-bond, right? T-bond interest rate. In other countries, it would be like different. In Indonesia, this would be the 7-day reverse repo rate. right? 7-day reverse repo rate that is quite close to BI rate. So again, the question here is, how do we define the risk-free rate? If we define it by saying that this is the interest rate offered by a government security, uh, do you think that a government or a central bank could go broke? Can they? And the answer is, of course, yes. Right? We have seen some examples of it, like the case of like Greece and some other countries. So actually, a government or a central bank could go broke. However, it's quite difficult for them to go broke. And can you imagine, like, if a government needs quick money, uh, quick liquidity because now it is in a bad situation, right? In a dire need for money situation, then the government can do many things, right? It has a lot of like authorities or ammunitions, right, to improve liquidity quickly. And you can mention a lot of things. For example, to borrow more money, right? To borrow more money domestically by issuing government bonds, government bills, or to borrow internationally, right? From World Bank, from other countries. Right? What else? The government could sell state-owned enterprises, maybe partially, right? Certain percentages of the government or the state-owned enterprises, or maybe in an extreme case, the government could sell islands. And we have seen a lot of cases. You see the case of Alaska, New Orleans. There's some other areas, right? Where one government was selling an island to another government. So this could happen, right? It's quite unlikely, but no, this is possible to happen. Or another possibility, this is dangerous one, to print more money, right? The government could print more money. Again, this is the most, I think, one of the most dangerous ones, but it's also very possible. So, of course, a central bank is independent, right? The position is independent. But again, see, in reality, especially in crisis situation, uh, a central bank tends to tends to be supportive to the government effort, especially to improve liquidity. So this possibility to print more money, right? This is the authority of uh, the central bank, but the government could ask for it. So you see, there are a lot of yeah. Again, the last one might be the most dangerous one, right? Because it will spark like hyperinflation. But again, this is the easiest one. You just print more money. You just go to maybe a bookstore, and then you find a history book, and then you find any photograph, right, who has not been used, right? Which picture has not been used for the money, right? Then you print using that like national hero picture or something like that. Okay, so the coupon interest rate must be above the risk-free rate. You can imagine that if the risk-free rate is 4.5%, so if you're a company and you issue a series of bond with a coupon rate of 4.5%, who will buy your bond? Nobody, right? Nobody will buy your bond because the risk-free rate is 4.5%. And if you offer a coupon rate of 4.5%, that doesn't make sense, right? Because the risk-free rate is 4.5, and this is without risk, and your company is risky, right? With risk. So you have to offer more than 4.5. But here's the question, right? Above 4.5 could mean anything, right? Could be 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, and so forth. So why do you finally choose 11%? Right? Why do you finally decide to offer a coupon rate of 11% to your bondholders? So the logic is very easy. You don't even need any theoretical knowledge about this, right? Just use your common sense. Why do you finally give 11% as a coupon rate? Of course, this is because 11% is the market rate at that time. So let me rephrase my statement, right? So you see here, at this point, right, when you want to issue the bond, right, a bond, and you find out that the market interest rate for this kind of bond, for this kind of risk characteristics is 11%, right? So if you have money and you go somewhere else and you find another investment alternative with the same risk, right, with the same characteristics, that other place also offers 11%, right? So we call it that market rate, right? Market rate, market rate for this kind of bond with this kind of risk characteristics. So what are we trying to say here? What we are trying to say here is that we can be almost sure, almost certainly sure that when you decide the coupon rate at one time, right, at one point in time, right now, the coupon rate that you decide most likely is or is certainly the market rate at that time, right? Market rate for this kind of bond with this kind of risk characteristics. So in other words, we are saying that the coupon rate when we issue the bond and the market rate would be the same or would most likely be the same because that's how we decided the coupon rate, right? We decided on the coupon rate. So we decided to give 11% because when we issued the bond, 11% was the market rate for this kind of bond with this kind of risk characteristics. Okay, so let me write it here. The market rate is 11%. That's why we, right now, right, we decide to uh, give a coupon rate of 11% because 11% right now is the market rate for this kind of bond with this kind of risk characteristics. Again, if you go somewhere else, you find another alternative with the same level of risk, that somewhere else, that investment alternative will give you 11% as well. Okay, so here's the thing, right? Once you promise, right, a certain coupon rate, for example, 11% in our example here, uh, once you offer 11%, uh, the coupon rate cannot change anymore. Coupon rate cannot change anymore because you have promised that level of interest rate. However, uh, the market rate will change from time to time. Okay, so once again, uh, we offered 11% when we issued the bond because 11% was the market rate for this kind of bond with this kind of risk characteristics at that time. But the coupon rate cannot change anymore. Once you offer 11%, it will remain 11% until maturity. On the other hand, the market rate for this kind of bond with this kind of risk characteristics will change from time to time. Yeah, not even next year, maybe in the next several months, uh, it will have changed already. So here's the difference, right? See the difference now? So imagine why do you want to suddenly redeem your bond before maturity? This is related to the market interest rate, right? So imagine that the market interest rate is increasing, increasing from 11 to 12%. Okay, so the market rate when we issued the bond was 11%, but now it's 12%. And we have promised to pay our bondholders 11% per whatever per period. Will you redeem the bond in the middle of now the journey of the bond? Certainly not, right? Certainly not, because now you have promised 11%. You have promised 11% to your bondholders, and actually, the market interest rate right now for this kind of bond with this kind of risk characteristics is already 12%. So you are happy, right? As a company, you are happy enough because you have promised only 11%, and now it's 12%, right? The market rate. So you definitely you will not do it. But let's see, your decision might be different if this is what is happening. The market interest rate right now is 10%, for instance. So again, you you have promised that 11% as a coupon rate. Why? Because when you issued the bond back then, the market rate for this kind of bond with this kind of risk characteristics was 11% at that time, right? So your coupon rate cannot change anymore. But right now, the market interest rate for this kind of bond with this kind of risk characteristics is only 10%. So you start thinking, right? Why should I why should I keep paying 11%, knowing that the market interest rate for this kind of bond with this kind of bond characteristics is only 10% right now? So if you have the call provision, there's a possibility that you would consider redeeming the bond before maturity, at least theoretically, right? Theoretically. But again, in practice, there are a lot of other factors to take into account. For example, uh, if you still need money, that means that you redeem the bond and you have to reissue uh, a new series of bond. And remember, when you want to issue a new series of bond, you have to go through the uh, again the what's that the investment bank process, right? Investment banking process. You have to hire again an underwriter. You have to do road shows and some other things. So those kind of activities might be quite costly. Okay, so uh, that kind of cost may outweigh the benefits that you get by redeeming your bond before maturity because of the decreasing market rate for this kind of bond. But theoretically, you could imagine if the market interest rate for this kind of bond declines, then theoretically you could consider redeeming the bond before maturity, should you have the call provision. But I could tell you that in modern bond, usually call provision is in place, is prevalent, I think, in modern bond issuance. So another clause that might appear, and again, modern, I think in modern bond issuance, a sinking fund is also um, like common, right? A common practice, right, in modern bond issuance. So what is sinking fund? You see the name here, fund that are sunk, funds that are sunk, right? So a sinking fund. So you could imagine it. What's the what's that? Uh, Depiction of the name. Yeah. So sinking fund means this is the fund allocated or being saved by the issuing firm to make sure that it could repay the coupon payment and also the principal on the maturity day. Right? So this may reduce the risk to investor, right? Because now the company is promising, right? The issuing firm has promised that it will allocate funds every period, right? It will save a certain amount of or set aside certain proportion of profit to the fund, right, to make sure that it could repay the coupon payment and also the principal payment. So it could reduce the risk to investor, right? If you see on the positive side, of course, right, with the sinking fund, the company has promised that it will save money, right? It will allocate money to the sinking fund. So here's interesting point number 4. If we combine the two stories together, or let me ask you first, right? If you see, if you're a potential investor and you consider a bond issued by a company that has promised to have a sinking fund, do you feel safer or less safe? Obviously, you feel safer, right? So this is like on one side, this is like positive positive factor or positive news to you as an investor. On the other hand, should imagine that if we have a combination of call provision and sinking fund, this could be like detrimental to investors. Why is that? Going back to our story, right? Call provision. Why do you want to execute the call provision? Of course, it's because of the declining market interest rate. A declining market interest rate. So when the market interest rate declines, like we saw in our example before, we imagine the market interest rate drops from 11 to 10%, and our coupon rate is 11% because when we decided on the coupon rate of 11% at that time, the market rate for this kind of bond with this kind of risk characteristics was 11%. But again, the coupon rate cannot change anymore, but the market rate for this kind of bond will keep changing. And now the rate drops to 10%. So you have the strong argument, you have the temptation to redeem the bond before maturity because now you're thinking you have been paying 11%. That's too high because the market interest rate for this kind of bond is now only 10%. So you might consider executing the call provision. However, the question is, do you have the money? Do you have the money? If you want to execute the call provision but uh, don't have enough money, then that cannot happen, right? That will not happen because you want to execute the call provision, you want to redeem your bond before maturity, but you don't have the money, then that doesn't happen. But remember here, if you have a sinking fund system, then most likely you have the money because you have allocated certain proportion of your profit to the sinking fund. So now you are saving money. So at the time you want to execute the call provision, you have the money also. So by combining call provision and sinking fund, what's that? Provision or close, this could be detrimental to investors because suddenly the company or the issuing firm uh, has the what's that, financial capability of redeeming its bond before maturity, and it has the right? It has the option through the call provision, and it has the financial ability due to the sinking fund. Okay, so now we're going to see the uh, estimation, right? The value estimation or the fundamental value of a bond. So see here a story, simple story here. We have a 10-year bond, right? So the bond is still 10 years to maturity, and the coupon rate is 10%, and the market rate is also 10%. So again, this is a simple example, okay? The earliest and also the simplest example where the coupon bond is still the same as the market interest rate. Okay, so let's see here. We draw it here. So 10 years to maturity, and this is an annual coupon payment. So we have 10 years and also 10 periods. And the coupon, what's that? The face value is not mentioned. It means that we follow typical value. So 1,000, right? 1,000. So the coupon rate is 10% per year. So 10% of 1,000 is 100. So obviously this bond will pay something like this, right? Coupon payment of 100, 100, and so forth, right? Period 4, period 5, period 6, 7, and so on. And the last one is in period 10. So the coupon rate is 10%. So the coupon payment is 10% of the face value, which is 100, right? 10% of 1,000 is 100. And in the story here, the market rate is still 10%. So a simple example here, the market rate hasn't changed, hasn't shifted, right? The coupon rate and the market rate are still the same, right? That is 10% in this example. Okay, so what is the fundamental value or the value estimate of this bond? And we just need to apply the present value, present value technique, yeah, present value technique. So here, 100, discounted back at the market rate. Be careful. So 10% here is the market rate. This is the market rate, not the coupon rate, okay? The market rate. So the first cash flow, the first coupon payment discounted back at the market rate, market interest rate, right? To the power of 1. And then this one divided by 1 plus 10% to the power of 2. Not because it's 2 years, but because of the 2 moves, right? 1, 2, and so forth, right? Till the last one, 1100 discounted back at 1 plus discounted back at market interest rate. The market interest rate is 10%, right, to the power of 10. Okay, so we'll use Excel. So here maybe, so we are looking for the present value. So what is the market rate? The market rate is 10%. Right? Market rate is 10%. Number of periods is 10. Number of periods. And then the annuity, the coupon payment is 100. Right? The future value or the face value here is 1000. Okay, so we find out that the fundamental value of this bond is still 1000. And you see the reason why is because the coupon rate is still the same as the market rate. Right? So the fundamental value of the bond is still 1000. It's still exactly the same as the face value. Okay, so what would happen if expected inflation rose by 3%, causing the market rate increases to 13%. Okay, so yeah, maybe let me redraw it. So you have 10 years, and then the face value is 1000, right? And the coupon rate cannot change anymore, right? It's 10%. 10% of 1000 is 100. Right? And now the market interest rate has increased to 13%. So market interest rate has increased to 13%. Right? So again, you see here this situation when we issued the bond, we gave a coupon rate of 10%. Why did we decide on the 10%? Most likely because when we issued the bond, the market rate for this kind of bond with this kind of risk characteristics was 10%. That's why we decided to give a coupon rate of 10% as well. But when the time passes, right, now the coupon rate cannot change anymore, but the market rate for this kind of bond has become 13%. Okay, so what would be the value estimate of the fundamental value of this bond? Okay, we are looking for the present value, right? So from this one plus now the market rate is 13. Okay, it's 13%, right? And yeah, to the power of 1, and then this the second one. So forth until the last one to the power of 10. Okay. So even without calculation, we could guess, right? What would change here? See, this is 10%, right? Now, mathematically, you could imagine if your denominator has changed from 10% to 13%. So your denominator, the what's it, the size of your denominator has increased. What will happen to the value? Of course, it will go down, right? So even without calculation, we know that the fundamental value of this bond will be lower than it was before. So before it was 1,000, the fundamental value was 1,000, which was the same as the face value. But now we know that your value estimate will decrease. But we don't know how much without calculating it, right? But what is the logic here? What is the logic that the increasing market rate, see here, increasing market rate will lead to a lower value of a bond. Right? Mathematically, we could see the logic, right? The denominator has gone up, right, from 10 to 13. Of course, here, mathematically, we know that the proceed will be lower or will decline. But what is the financial logic here? It's quite simple, right? So imagine you are one of the buyers of the bond, the buyers, and you have been enjoying it. What's that? 10% here. You have been enjoying 10%, right, of coupon rate. But now you find out that actually the market interest rate for this kind of bond with this kind of risk characteristics has become 13%. So are you happy or unhappy? Think about it again, right? You have been enjoying 10%, right, of a coupon rate promised by the issuing firm. But now you find out that actually the market interest rate for this kind of bond with this kind of risk characteristics has become 13%. Obviously, you are unhappy, right? Because you are only enjoying 10%, while the market rate for this kind of bond has been 13%. So what is the concrete action or the real action of unhappy investors such as you? Many investors are willing to sell the bond, right? So because they are unhappy, many of them will try to sell the bond because now the coupon rate is not that interesting. You are only enjoying 10%, while the market rate for this kind of bond has been 13%. So many investors will sell, many bondholders will sell their bonds, and something being sold by many people will experience what? A lower price. Common sense, right? Because many people want to sell that thing, then the price of that thing will go down, right? So even without calculation, based on the financial logic, we know that the value will drop. So let's calculate now. So we're estimating the present value. So what is the market interest rate right now? Market interest rate 13%. Yeah, 13%. Number of periods is still 10 years. Payment, coupon payment is 100, the 10% of 1,000. And the future value or the face value is 1,000. Okay, so 837, right, as predicted, right? Even before the calculation, we predicted that the price would go down because of the increasing market rate. And we see the proof now. The fundamental value of the bond is now 837.21 cents. So let me ask you some scenarios here. In your estimate, in your what's that? In your analysis, you believe that the fundamental value should be 837.21 cents. But if you look at the stock exchange or the securities exchange, you find out that this bond is traded at 900, right? 900 on the capital market. So what is your decision? Okay, in your analysis, in your estimation just now, uh, you came up with a conclusion that the fundamental value of this bond was 837. But in the capital market right now, this is sold at 900. What should you do? This one means what? Too expensive, right? Too expensive because in your valuation, it should have been 837.21, but this is being sold at 900. So this is what overpriced, right? Or overvalued. So what should you do? Overvalued? If you don't have it, you should not buy it, right? If you have it already, this is overvalued, then you will sell it. Okay, so if you have it and you think that this is overvalued, it should have been 837, but now it's traded at 900. So you should sell it because it's overvalued. But if you don't have it, you don't buy it. And in some countries where you can do the short selling, you should do the short selling because in your expectation, the price will decline, right, from 900 to 837. So you can do the short selling because you sell something that you don't have by borrowing from your broker. So you borrow the bond from your broker and then you sell it, right? And then you will return the bond to the broker plus interest maybe in 2 weeks, in 1 month, or any time frame. Okay. So what about um, in the capital market? This is being sold at 800. So in your analysis, uh, you draw a conclusion that then the fundamental value should be 837, but it's now traded at 800 on the capital market. So this is what? Too cheap, right? We call it undervalued. Something undervalued is good, right? We always try to find the undervalued things or assets, right? So undervalued thing, for an undervalued thing, if you don't have it, you should buy. So the recommendation is buy because again, in your analysis, you believe that the fundamental value is 837, but it's now traded only at 800. So you should buy because it's undervalued. So we'll continue with the next uh, scenario. So next possibility is the market interest rate drops to 7%. So the market interest rate drops from 10 to 7. Okay, 10 to 7. So instead of increasing from 10 to 13, now it has dropped to 7. So I should write it down again with the red color. So now it's not 13, but 7. Okay, so what has changed here? What will change? Of course, the denominator. So not 13, but 7. So 7% instead of 13. Okay, now you see the mathematical logic first. Now from 10, this has dropped to 7, right? So your denominator has dropped in size. Of course, this will increase, right? Because now the denominator drops in value. Now the value that you're looking for will increase. That's the mathematical logic, right? But what about the financial logic? So think about it again. You have been promised 10%, right? 10% coupon rate. You have been enjoying 10%, and now uh, the market interest rate for this kind of bond with this kind of risk characteristics is only 7%. So as an investor, are you happy or sad? Of course, you're super happy, right? You're super happy because, again, you can imagine, you have been enjoying 10% coupon rate, but actually the market interest rate for this kind of bond with this kind of risk characteristics is 7% right now. So you're very happy. So something like this would be uh, quite attractive, right? So many people want to have or want to buy this bond. Again, why? Because uh, that it has promised that 10% coupon rate, but actually the market rate for this kind of bond is only 7% right now. So many people want to buy this bond. So something uh, sought after by many people will increase in price. Can you imagine, right? Something pursued by many people, right, will increase in price. So that is the financial logic, right? So let's prove it here with our Excel. Looking for the present value. Market rate right now is 7%. Market rate is 7%. Number of periods is 10. Coupon is 100. Future value is 1,000. Right. So as expected, see here, we find out that the fundamental value of the bond has increased to 1,210 and 71 cents. Right, because now it's uh, highly sought after, highly pursued by many people because it's offering 10%, while the market rate for this kind of bond is only 7% right now. So let me ask you again, if the fundamental value that you believe is 1,210, what if this bond is currently traded at 1,500? What will you do? You believe that the fundamental value is 1,210, uh, whereas the real price right now on the capital market is 1,500. So this is too expensive, right? We call it like overvalued, overvalued. So you should sell it, or you should not buy it if you don't have it right now. Or in some countries, you can do the short selling, right? What if the current market price on the capital market is 1,000? You believe that this is the fundamental value, right, based on our analysis, but the real price on the capital market is 1,000 right now. So this is what? Undervalued. Too cheap, right? Undervalued. So the recommendation is to buy. You should give the a buy recommendation, right? It's undervalued. Okay. So we see here, this is the principle of bond price, right? So which one? I think this one. See here, we saw this one before. When the interest rate increases, right? When the interest rate increases from 10% to 13%, the price will drop, right? The price will drop to 837. So we call it like discount situation. This is at discount. We call it at discount, right? The bond price is at discount because the face value is 1,000, while the price right now is 837. When the market interest rate increases from 10 to 13%, right? But you see here, as the time passes, right? As the time passes and the bond is approaching the maturity day, the price will increase. So this is very different from the nature of stock that we can see in another video. So in the case of stock, we don't have any maturity date. We don't have any maturity, right? It's perpetual. It will be like infinite. But here, when we buy or when we issue a bond, we have a certain maturity date. So you see here, when the bond is at discount, right, 837 at discount because of the increasing market rate, As the time passes, the price will go up and approach the face value. So the face value is 1,000, right? So on the other hand, we saw which example here? This one, this example as well. We use this example, and 1211 prevailed when the interest rate drops from 10 to 7%. Our second example, right? So when the market rate drops from 10% to 7%, the fundamental value will increase. So again, we have a reverse relationship, right? Reverse relationship between the market interest rate movement and the fundamental value of a bond. If market interest rate increases, then the value of a bond will decrease, and vice versa. Right? If the market interest rate drops, then the value of the bond will increase. And here is the second case where the market interest rate drops from 10 to 7%, and the value of the bond increases to 1211. So we call it what? This is a condition of, sorry, of premium. So we say that the bond is at premium, right, higher than the face value. But you see here, when the time, with the time, with the time passing, uh, the value of the bond will be lower, right, approaching the face value at maturity. The face value is 1,000. And so from a premium position, the price will decline, right, to approach the face value of 1,000 when it reaches the maturity date. Right? So this is the nature of bond price movement, right, approaching the maturity date. Okay, so far we have talked about the um, value, right, market valuation. So uh, we're going to proceed with another indicator, right, very important one, the yield to maturity, the YTM, okay, YTM, yield to maturity. So you see the name here, yield is result, right, and to maturity. So this is easy to guess, right? So this is the uh, return, result or return that you will enjoy if you hold this bond until maturity. That's what we call yield to maturity. So result until maturity, right? So once again, this is a uh, return that you will really enjoy if you hold this bond from now until maturity. Okay, so this is just the reverse of a situation here, a reverse of analysis. So previously, we see this situation, right? We have, for example, 10 years or 10 periods, and we try to estimate the value of the bond if we know the coupon payment, right? Coupon payment is the previous example was 100, right? 100. So 10% of 1,000. Okay. So we know the coupon interest rate, and we also know the market rate, right? Market rate, for example, what, 7%? The second example, it has dropped. The coupon rate is 10%, but the market rate is now only 7%. And we try to estimate, the value of the bond or the fundamental value of the bond. But you see, if you believe that current market, so the current price on the capital market, right, on the bond exchange, if you believe that the current price on the capital market is a fair and equilibrium price, okay, then you could say that value of that bond is your equilibrium price, whatever it is, maybe 900 or maybe for example 1,100, 1,100. Okay. So in this situation, now you are asking, right? What is the What's the yield to maturity? You see the difference, right? In this case, you believe that the current price on the capital market, right, 1,100, you believe that this is the equilibrium price, a fair price, or the fundamental price. So you believe that the current price on the capital market is the fundamental or the fair price. Now you're asking, right? If you have this bond right now that costs 1,100, but give you this much, how much is the yield to maturity? Right? How much is the result that you will enjoy, that you really enjoy from now until maturity? Okay, so we'll see an example here. So 10 years ago, the coupon rate is 9%. The face value is 1,000. But here you see, the current price is 887. The current price is 887. Hmm. So you have 10 periods to go, and the coupon rate is face value is 1,000. Coupon rate is 9%. So at the end of the maturity, we'll get 1,000, but we get 90 now, right? 9% of 1,000 is 90, 90, 90. Okay, and we believe that the current price, right? The bond is currently sold or currently selling at 887. So 887. We believe that 887, the current price is also the fundamental or equilibrium price. And I intentionally give minus sign there to signify the cash disbursement, right? The cash outflow. If you buy this bond, you have a cash outflow. So we give a minus sign. So now the question is, in this with this scenario, with this situation, how much is your yield to maturity? So the real, what's that, the result that you will really enjoy if you hold this bond from now until maturity. So you could imagine here, we know the present value. We know the present value. Uh, 887 should be the function of the first cash flow discounted back at, this is what we are looking for, plus the second one, to the power of 2, and so forth, right? And the last one, 1090, 1 plus yield to maturity to the power of 10. See, so we are looking for the denominator, and of course, uh, without calculator, it's very difficult to find the denominator, and they should be the same, right? The uniform denominator. But see the logic again. We believe that 887 is the equilibrium price, right? The market, the current price is the equilibrium price. We believe that. So with this situation, how much is return? How much is the return that you will enjoy by holding this bond from now until maturity? Okay, so we use the Excel. So we are looking for rate. So the rate, number of periods is 10. Coupon payment is at 9% of 1,000 in this example. So 90. The present value is 887. And remember, this is cash outflow, so we give a sign, a minus sign, right, to tell the calculator that this is a cash outflow. And then the future value or the face value is 1,000, right, at the end of maturity, on the maturity day. Okay, so we find out that the uh, yield to maturity is 10.91%. Right, so 10.91%. So this is the return or the result that you really enjoy by holding this bond from now until maturity. So 10.91%. So another scenario here, the current price is not 887, but it's 1,134 at 1134. So you could actually even without calculation, you could guess. The face value is 1,000. The par value or the face value is 1,000. So the current price on uh, on the capital market is 1,134. So you know that the price has been above the face value, meaning that the interest rate or the market interest rate or the return that you enjoy has dropped. You can see the our relationship again. If market interest rate increases, bond value will drop, and vice versa. Right? If market interest rate decreases, then the bond value will increase. And here we see that the bond value has increased. Right? The face value is 1,000, but now uh, the current price is already 1,134.20. So the price has increased, meaning that the market interest rate has dropped. Right? The market interest rate has dropped. So the yield to maturity must be lower than the coupon rate. Right? The coupon rate is 9%. So again, from even without calculation, we could guess with the current price of 1,134 and 20 cents. We could imagine. So the market rate has so the current price has increased, right, from 1,000 to 1,100. That indicates that the market interest rate or the yield to maturity has declined. So let's calculate. 10 years to go. The face value is 1,000 and the coupon rate is 9%, right? So 9% of 10,000 is 90, right? 90, and 1,000. And the current price is 1,134.20. So the question is, how much is your yield to maturity? Return that you will enjoy by holding this bond from now to maturity. So do it similarly here. 1,134.20 should equal 90. The first 90 divided by 1 plus yield to maturity to the power of 1. And then the second one, 90 plus yield to maturity to the power of 2, so forth until the last one. 1,090, 1 plus yield to maturity to the power of 10. Okay, so even without calculation, we know that your yield to maturity will be lower than the coupon coupon rate. So rate, number of periods is 10. So payment, coupon payment is 90. Present value right now is oh, uh, 113,420. So we pay, right? We buy the bond, 113,420, and the face value is 1,000. Okay, so you see here, 7.08%. So again, even without calculation, we know that the yield to maturity will be lower than the coupon rate, right? Because the current price is already higher than the face value. You see the reverse relationship. If market interest rate declines, right, the bond value will increase. Okay, so yield to maturity has two components. Two components. The first component is current yield, and the second component is the capital gains yield. So let's see the first one here. Current yield is annual coupon payment divided by current price. So we can check for this one. For 1091, this yield to maturity, 10.91%. So what is the first case? Okay, this one, right? So the yield to maturity is 10.91%. So it has two components. The first one is current yield. Second component is capital gains yield. Okay, so for the first example, this is what, 1091, the yield to maturity. So now what is the coupon? What's the current yield? Current yield is, what's that? The coupon. How much is the coupon for this example? 90, right? 90 right here. The for current yield, 90 divided by the current price. And the current price for the first example is 887. So let me calculate also. 10.15%. So the current yield, again, the coupon payment divided by current price is 10.15%. So of course, if the total is 1091 and the current yield is 10.15%, then the capital gains yield would be the difference, right? So 1091 minus 1015. So we know that the capital gains yield is 0.76% because the current yield is 10.15, right? So what about the second example? Second example here, what's the yield to maturity again? Yield to maturity for the second one is 708. So 708%. It has two components. The first component is the current yield. Current yield is current yield. So coupon payment divided by current price. Current price is 113,420. 7.94. 7.94%. So what is the capital gains yield? Of course, the difference, right? So the total is 7.08%, and the current yield is 7.94. So we know that the capital gains yield is minus 0.86%. Okay? So why is the capital gains yield minus? Because now you see the price is already the price is 1,134.20, and so several slides ago, we know that this price will decline, right, from time to time to approach 1,000 at maturity, because that's the nature of the bond. Here, you see this picture again, right? So if it's in the premium right now, the price will decline when we approach the maturity. So the capital gains yield will be negative because now the price is already above the par value. Okay, so we have seen the yield to maturity, and now what about the case of like semi-periodic bonds? So examples that we have seen so far, we're using like annual system, right? One period is a year, but it could be that in some countries or the policy of certain companies that they'll pay the coupon like semi-annually or maybe quarterly even, right? So we see an example here, semi-annual. So we have to be have to be careful with the number of periods and also the uh, all other indicators. So now everything should be in the periodic measure. So let's see an example here. 10 years to go, right? 10 years to go. Coupon rate is 10% per annum, right? Annual coupon rate is 10%. And uh, this is semi-annual, right? Semi-annual, it means that meaning that the bond is paying the coupon like twice a year, semi-annual. And the market rate is 13% per annum. So we have to be careful here. So we have 10 years to go, but semi-annual. So how many periods do we have? 20, right? 20 periods. Because we have 10 years to go, but the system is semi-annual. The coupon payment is semi-annual. So we have 20 periods to go. And the face value is 1,000, of course. So when we redeem the bond at maturity, we'll get 1,000 apiece. So what information? What else? Okay, now the coupon rate is 10%. So 10% of 1,000 is 100, right? So the coupon payment is 100 per year. But if we use the semi-annual system, then it's 100, right? 10% per year. So 10% of 1,000 is 100. But because this is semi-annual, so we have to pay like 50 and 50. Agree? 10% of 1,000 is 100, but it's semi-annual. So uh, 50 and 50, right? 50 and 50, and so on, right? So 50 per period or 100 per year. The coupon rate is again 10% per year. Right? And another information is what is that? The market rate is 13% per year. Be careful. The market rate is 13% per year per annum because we are using the semi-annual system. So this would be 6.5, right? So 6.5% per period. Okay, so what is the value estimate? Again, we try to estimate the fundamental value. So 50 divided by 1 plus, be careful here, the market rate per year is 13, but the market rate per period is 6.5, semi-annual, right? Plus this one, to the power of 2, and so forth. The last one is 1050. 1.6.5% to the power of 20. Okay, so you see the pattern here. Everything is in period, right? So the number of periods, and then the coupon payment per period, then the market interest rate per period. You have to be careful with that, right? So let's recalculate here. So we want to estimate the value of the bond, present value of the bond. So market rate right now is 6.5%, right? If you are lazy enough, you can write it this way: 13% divided by 2, just the same thing. If you are lazy, you ask the calculator to calculate it for you. Right. So uh, yeah, if you want to calculate it first, it's okay. 6.5%, right? Because you might find uh, in a certain case that the numbers are difficult to calculate. For example, 13 divided by 2 is easy, right? But let's say this is like monthly analysis, right? Monthly analysis, and the annual interest rate is 17%. So what is the periodic interest rate? You can imagine, right? The annual interest rate is 17%, but this is monthly. So 17 divided by 12, what is it? Of course, we don't know, right? So it's better to write 17% divided by 12. Number of periods, 20, right? If you are lazy, you can write it this way. So 10 years, that's semi-annual, right? So payment, same thing here, is 50. Right? But if you are lazy enough, you can write 100, but semi-annual, right? And the face value is, of course, 1,000. So we find out that the price or the fundamental value of the bond right now is 834 and 72 cents. If the payment is semi-annual instead of annual. Okay, so I think one more terminology here that we are going to see is the yield to call. So remember the call provision. A call provision is an option or a provision to call or redeem the bond before maturity. So the issuing firm has an option, right, to redeem its bond before maturity. So this is an option, right? So the company might do it, the company might not do it, right? This is an option. So because this is an option, uh, this is more favorable, or let me rephrase it. The issuing firm is at a more favorable position because it has the option, right, as to whether to uh, execute the option or to just let the option lapse without execution. That's why if the company redeem the bond before maturity here, it has to pay a higher redemption price, higher than the par value or the face value. And the amount here is 1,050. So imagine again, uh, if the bond is continuing, like proceeding until maturity, then the issuing firm will pay 1,000 at the end, right? 1,000 the redemption value. But if the company redeem the bond before maturity, the company has to pay 1,050 instead of 1,000. So this is to compensate the bond buyers, right, bond holders, of the disappointment, right, because what they have been enjoying so far is suddenly called off, right? Suddenly redeemed by the company before maturity. Okay, so let's see the information here. This is a 10-year bond or 10 years to go, 10% coupon, but be careful, semi-annual. This is semi-annual, 10% coupon rate. The par value, the face value is normal, 1,000, typical face value. The current price is 1135, 1135.90 cents. So now we could estimate. Let me draw it here. So tell me again, this this bond has like 10 years to go, but semi-annual. So how many periods? 20 periods. 10 years, right? But semi-annual. So we have 20 periods to go. And the face value is 1,000, typical value. So we will get 10,000 if we hold the bond to maturity, right? So at maturity, on the maturity day, we will get 1,000. The coupon is 10%, right? But be careful, semi-annual. So 10% of 1,000 is 100, right? But 100 per year. So what is per period? 50, correct? So 10% of 1,000 is 100, but that is per annum. So for semi-annual case, this would be 50, right? 50, 50, 50, right? And so on, right? And then in the information tells us that uh, the immunity only lasts for 5 years. So you see here, it can be called after 5 years. This is an important information, right? It means that for the first 5 years, that that will be an immune period, right? So the bondholders have immunity over the call provision. So the company could redeem the bond before maturity only after 5 years. So when is that? It's period number 10, right? So period number 10 is the fastest. So the fastest, right? So the uh, like call provision may not be executed in year 5, right? It could happen in year 6 or period number 12, could be year 7, could be year 8, and so forth. But it could start redeeming the bond before maturity only after 5 years. So during the first 5 years, the bondholders are immune. So this bond cannot be redeemed before 5 years, right? So, but after 5 years, now the issuing firm has an option to redeem the bond, right, before maturity, and the maturity is year 10, right, or after 20 periods. So now we could estimate one more information. The current price is 1139. Oh, sorry, 1135.90. Again, minus means cash outflow. Okay. So what is the yield to maturity? So we could estimate yield to maturity 135.90 should equal the first 50 divided by 1 plus yield to maturity to the power of 1 plus the second one, 50, 1 plus yield to maturity to the power of 2, and so forth. Right? The last one, 1050, 1 plus yield to maturity to the power of 20. So rate, right? Rate, right? Yield to maturity is rate, number of periods, Be careful, 20, right? 10 years, but 20 periods. So number of periods is 20. Amount of payment, be careful, right? This is 50, 100 per year, but 50 per period. Then the current price 1135.90. Remember the minus to show that this is a cash outflow. So 1135.90. Future value is 1000. This is the face value. If you hold the bond until maturity, you get 1000. Okay, so 4%. This is the yield to maturity, but be careful, this is per period, right? Because period analysis, so the yield to maturity will be in period as well. So it's 4% per period. So what about the annual? So we multiply by 2. So 8%. So this is the yield to maturity per annum, right? So 4% is per period. So we multiply by 2. We call it APR, annual percentage rate. Annual percentage rate. Of course, if you want to calculate the effective rate would be 1 plus the periodic rate, right, to the power of 2, right? So instead of multiplying, we are compounding, right, with the APR, simply, right, 4% times 2, right? This is APR. But for the effective rate, this 1 plus the periodic rate to the power of 2, not multiplying by 2, but to the power of 2, and then minus 1. But we are not focused on effective rate, right, in this topic. So we'll simply use the APR. So we know that the yield to maturity is 8% per annum. Okay. So what about the yield to call? So can you guess the terminology here? What is the meaning of yield to call? So yield to maturity means the return or result that you will enjoy or you will really enjoy by holding the bond from now until maturity. So what is yield to call then? So yield to call would be the result or return that you will really enjoy by holding this bond from now until being called, right? Until being called. That's why we call it yield to call. And you see the information again? It can be called after 5 years. So we have a lot of measures for yield to call. For yield to maturity, we only have one. You can imagine again, this is the return that you will enjoy by holding the bond from now until maturity. But yield to call means return that you will enjoy by holding this bond from now until being called. So see here, the possibility of being called would be what? Year 5, maybe year 6, maybe year 7, and so forth. So we have a lot of possibilities, right? But for yield to call, for yield to maturity, we only have one possibility. That is the maturity, right? If we hold the bond from now until maturity. But yield to call, we have many possibilities. Maybe year 5, maybe year 6, year 7, year 8, or year 9. Let's use one of the possibilities. Let's assume that the first possibility is the call provision will be executed at year 5. By year 5, so you could imagine at year 5, so this is the current price, should be a function of what, 50? 1 plus yield to call to the power of 1. Right, this one, right? I use red color, right? Plus second one, 50 plus yield to call to the power of 2, and so forth, right? What is the last one? If we suspect that this might be called at year 5, so here, right? So 50 to the power of 10 at 5 years, right? And remember, uh, if this is redeemed at maturity, the company will pay 1,000 of face value. But if this is redeemed before the time, they will pay 1,050. Okay, so the last cash flow is what? 1,050 plus 1,050 is 100, right? Again, the 1,100 here is 50 for the coupon and 1,050 for the call price because they redeem the bond before maturity. Again, if they redeem the bond at maturity, they'll pay 1,000. But if they pay the bond before maturity, they will have to pay 1,050. So in total, 1,100 for the last cash flow. Okay, so then we put into calculator to determine the yield to call. So what if we want to know the yield to call at year 6, then it would be 50, right? Yield to call to the power of 1 plus so on plus, see, at year 6, it means yield to call to the power of 12. This is at year 6, right? And again, the 1,100 is like 50 uh, from the coupon and 1,050 from the call price. Okay, so you could continue the possibility to year 7, year 8, right? But we'll use only year 5, right, as comparison. We put into the Excel rate, number of periods. So if we suspect that this would be called at year 5, then number of periods is 10 at year 5. 5 times 2 is 10. Payment is 50 per period. Coupon payment 50 per period. And what's the price again? 1,135.90. So minus, right? We buy it 90. So the future value again here, if this is redeemed at year 5, they will pay 150, 1,050, not 1,000, but 1,050. Right. Okay, so what is it? 377, and the APR per year is okay. So the yield to call is 753. So yield to call is 7.53% if you believe that it will be redeemed at year 5. But if you suspect that it will be redeemed at year 6, then you have to recalculate, right? Because the number of periods will be 12 instead of 10 and so forth. So I hope you understand this one well. Right? Again, what's that? Yield to maturity is the return that you will enjoy if you hold the bond until maturity. Yield to call is the return that you will enjoy by holding the bond from now until being called. So the call price will be different from the par value. Okay, so to end our discussion today, we look a little bit into the formation of interest rate. So we have talked about market interest rate here. Again, market interest rate means this is the market interest rate for this kind of bond with this kind of risk characteristics. So you see the components here. This is a real risk-free rate, right? And this is the inflation premium. So in combination, The R star plus IP is the risk-free rate or the nominal risk-free rate. So this is easy to dissect using the nominal and real rate system, right? We know that 1 plus nominal rate should equal 1 plus real rate multiplied by 1 plus inflation rate. Okay, so if you want to find that 1 plus real rate, this would be what? 1 plus nominal rate divided by 1 plus inflation rate. Okay, but uh, under, if you want to be quick, okay, you could do it in a simplified way. So nominal rate is equal real rate plus inflation. So this is the how to say, like, the fast track. Okay, so it's informal, but uh, not too far. The result is not too far away from the formal version. So this is the formal version in economics. Right? 1 plus nominal rate should equal 1 plus real rate multiplied by 1 plus inflation rate. But if you're on the street and you want to be quick, right? So quick estimate, you can call it like quick estimate. So nominal rate is simply as measured as real rate plus inflation. And this is what we are using here, you see. So this is a real interest rate, real risk-free rate plus inflation premium. So the R star plus inflation premium is the nominal risk-free rate, nominal risk-free rate. And we discussed this in details in international finance. We see a lot of parity conditions and something like that. So you can watch my videos on like international finance topics. And this one is what? Maturity risk premium. You see, the longer the maturity, the higher the risk, right? So of course we cannot predict, right, 1 year from now or 10 years from now or even tomorrow, but at least the shorter the horizon, uh, the easier it is to project, right, or to predict. So the longer the horizon, the more difficult uh, it is, right, to project or to predict. So maturity risk premium, the longer the maturity, the higher the maturity risk premium. What about this one? Default risk premium. So the higher the possibility of default means, again, inability to repay its coupon payment and or the principal payment, right? So the higher the uh, default risk, right, the possibility of getting default, then the higher the risk premium, right? The higher this premium. And liquidity premium. So the less liquid a company is, the higher the liquidity premium that will be added into the market interest rate. Market interest rate for this kind of bond with this kind of risk characteristics. So you see again the components: risk-free rate, market risk premium, right? So the longer the maturity, the higher the market risk premium, right? Added into this number, right? The market rate for this bond, and then the higher the possibility of default, the higher the risk premium as well. The higher the premium from the DRP, and then this one, the less liquid a company is, the higher the premium for liquidity will be. Right? Common sense. and all of the components will uh, add up to the market interest rate for this kind of bond with this kind of risk characteristics. Okay, I think we have discussed quite extensively about bond valuation, bond and its valuation. And of course, there are a lot of other aspects of bond that are not discussed in this video. But if you want to know more about the interest rate risk, you can watch my videos on interest rate risk and some measurement methods, right? Some measurement methods, including the use of like duration method. Usually in bond management, we rely a lot on duration method. Now, I discussed that a lot in those videos on interest rate risk. So thank you very much for watching this video. I hope it benefits you, right? Expanding your knowledge about bond and its valuation. And we meet next time with another valuation. Thank you.